Question 1. What is the primary principle underlying the concept of indemnity and casualty insurance? A. The insurer's obligation to pay the insured a fixed sum regardless of the loss. B. The insured's right to receive compensation for the loss incurred, ensuring they are restored to their pre-loss financial condition. C. The insurer's ability to limit their liability by setting a maximum payout amount. D. The insured's requirement to disclose all potential risks before obtaining coverage. Answer. B. Explanation. The principle of indemnity is a fundamental concept in casualty insurance that aims to restore the insured to their original financial position before the loss occurred, without allowing for any profit. This ensures fairness in the insurance process. According to the Oregon Revised Statutes Laws, Chapter 742, indemnity means that the insured is compensated for the actual loss incurred, thus preventing any moral hazard. Option is incorrect because indemnity does not involve a fixed sum payment but rather reflects the actual loss. Option C is also incorrect. While insurers may set coverage limits, this is distinct from the principle of indemnity. Option D relates more to the concept of utmost good faith, which requires full disclosure from the insured. Question 2. Under the Oregon insurance regulations, which of the following is a primary requirement for a producer to maintain their license? A. Completing a minimum number of continuing education hours every 2 years. B. Having a minimum net worth of $100,000. C. Submitting to a background check only upon initial licensing. D. Maintaining an office in the state of Oregon. Answer A. Explanation. In Oregon, licensed insurance producers are required to complete continuing education as part of maintaining their license. Specifically, the Oregon Department of Consumer and Business Services outlines that producers must complete a minimum of 24 hours of continuing education every 2 years, including 3 hours in ethics. This ensures that producers remain knowledgeable about current laws and industry practices. Option B is incorrect. There is no net worth requirement for maintaining a license. Option C is misleading. While background checks occur at the time of initial licensing, ongoing compliance requires reporting any legal issues that may arise. Option D is incorrect as producers can operate from various locations, not necessarily requiring a physical office within the state. Question 3. Scenario-based question. Mr. Thompson owns a small manufacturing business and recently faced a lawsuit due to a product defect that allegedly caused injury to a consumer. The lawsuit claims both bodily injury and property damage. Which type of insurance should Mr. Thompson primarily rely on to cover the potential liabilities stemming from this lawsuit? A. General liability insurance. B. Workers' compensation insurance. C. Professional liability insurance. D. Commercial auto insurance. Answer A. Explanation. In this scenario, Mr. Thompson should primarily rely on general liability insurance. This type of insurance provides coverage for bodily injury and property damage claims resulting from products manufactured by the insured, which is crucial in cases where defects lead to injuries or damages. According to ORS Chapter 742, general liability policies typically include coverage for legal defense costs and settlements related to product liability claims. Option B, workers' compensation insurance, is not applicable here, as it covers employee injuries and does not address claims made by third parties. Option C, professional liability insurance, is designed for professionals who provide services protecting them from claims of negligence, which is not relevant to a manufacturing context. Option D, commercial auto insurance, is specifically for vehicle-related liabilities and does not cover product liability claims. Question 4. Which of the following best describes the term subrogation in casualty insurance? A. The process by which an insurer pays a claim and then seeks reimbursement from the party at fault. B. The requirement for policyholders to disclose all information relevant to their coverage. C. The right of the insurer to adjust policy limits based on changing risks. D. The act of combining multiple policies under one premium. Answer A. Explanation. Subrogation is a key principle in casualty insurance that allows an insurer to recover costs from a third party who is responsible for a loss after they have paid a claim to the insured. This process helps maintain the integrity of the insurance system by preventing the insured from profiting from their losses. The Oregon Revised Statutes Laws support this practice, allowing insurers to step into the shoes of the insured to pursue recovery. Option B relates to utmost good faith, while option C is incorrect as policy limits are generally fixed unless specifically adjusted by endorsement. Option D refers to a policy bundling strategy, not subrogation. Question 5. Which of the following coverages is typically included in a standard general liability insurance policy? A. Coverage for damages resulting from contractual obligations. B. Coverage for medical payments to third parties without regard to fault. C. Coverage for pollution liabilities. D. Coverage for product recalls due to defects. Answer: B. Explanation. A standard general liability insurance policy includes medical payments coverage, which pays for medical expenses incurred by a third party due to injuries sustained on the insured's premises, regardless of fault. This coverage is designed to prevent lawsuits from minor injuries. Option A is incorrect because damages from contractual obligations are generally excluded. Option C is not included in standard policies, but may require additional coverage or endorsements. Option D is also excluded unless specifically included through an endorsement, as product recalls often require specialized coverage. Question 6. In the context of Oregon's insurance regulations, what is the primary role of the Oregon Department of Consumer and Business Service (ECBS)? A. To provide financial assistance to insurance producers. B. To regulate and oversee the insurance industry and ensure consumer protections. C. To set insurance premium rates for all insurers operating in Oregon. D. To approve all insurance policy forms before they can be sold. Answer: B. Explanation. The Oregon Department of Consumer and Business Service (DCBS) plays a crucial role in regulating the insurance industry, ensuring that it operates fairly and within the law while also protecting consumer interests. This includes overseeing licensing, handling complaints, and enforcing insurance laws. Option is incorrect. DCBS does not provide financial assistance to producers. Option C is misleading. While the DCBS influences rate approvals, it does not set rates directly. Option D is incorrect. Insurers must file their policy forms, but not all forms require prior approval. Question 7. Which of the following is an example of a condition in an insurance policy? A. The right of the insurer to cancel the policy at any time. B. The insured's requirement to report any claims within a specified time frame. C. The maximum payout amount for a claim. D. The scope of coverage for specific events. Answer: B. Explanation. Conditions in an insurance policy specify the obligations and responsibilities of the insured. One common condition is the requirement to report claims within a specific time frame, which is critical for the insurer to effectively assess and process claims. This condition ensures timely communication and helps prevent fraudulent claims. Option A is not a standard condition. Cancellation rights are typically defined separately. Option C refers to policy limits, not a condition. Option D describes coverage scope but does not represent a condition. Question 8. In workers' compensation insurance, what is the primary obligation of the employer? A. To provide coverage for employees' medical expenses regardless of fault. B. To ensure that employees receive full salary during the claims process. C. To maintain a safe working environment to prevent workplace injuries. D. To provide temporary disability benefits only for a specific duration. Answer: C. Explanation. Employers have a primary obligation under workers' compensation laws to maintain a safe working environment. This is crucial to prevent workplace injuries and minimize claims. The Oregon Workers' Compensation Division outlines employers' responsibilities in providing a safe workplace. While employers do cover medical expenses and may provide benefits during recovery, the primary duty is safety. Option A is misleading as it does not capture the preventative aspect. Option B is not an obligation. Employers typically provide benefits based on the nature of the claim. Option D is incorrect. Benefits can vary based on state law and the nature of the injury. Question 9. What is a primary factor that insurers consider when underwriting a commercial auto insurance policy? A. The driving history of the business owners only. B. The primary use of the vehicle in the business operations. C. The number of employees in the company. D. The age of the vehicles being insured. Answer: B. Explanation. The primary use of the vehicle in business operations is a crucial factor in underwriting commercial auto insurance policies. Insurers assess the level of risk associated with how the vehicle is utilized, e.g., delivery, transporting goods, as this impacts the likelihood of accidents and claims. ORS Chapter 742 emphasizes that underwriting must accurately reflect risk exposure. Option is incomplete. While driving history is important, it's not the sole factor. Option C may influence risk but is secondary to vehicle use. Option D is relevant but not as significant as operational use. Question 10. Which of the following best describes the term exclusion in an insurance policy? A. A benefit provided to policyholders for specific types of losses. B. A provision that limits or restricts coverage under the policy. C. An endorsement that adds coverage for additional risks. D. A requirement for the insured to disclose previous claims history. Answer: B. Explanation. Exclusions in an insurance policy are provisions that limit or restrict coverage for certain risks or losses. They delineate what is not covered, which helps insurers manage risk and avoid unintended losses. Understanding exclusions is vital for both insurers and policyholders to ensure clarity on coverage limits. ORS Chapter 742 outlines the importance of transparency regarding exclusions in policies. Option: it describes inclusions, while option C refers to endorsements, not exclusions. Option D relates to disclosure requirements but does not pertain directly to exclusions. Question 11. Under Oregon's workers' compensation law, which of the following is not a benefit typically provided to injured employees? A. Medical expenses for treatment related to the injury. B. Rehabilitation services to help return to work. C. Coverage for lost wages after the first week of disability. D. Permanent salary continuation for life regardless of employment status. Answer: D. Explanation. Under Oregon's workers' compensation law, employees receive benefits such as medical expenses, rehabilitation services, and temporary disability benefits for lost wages, typically starting after a waiting period. However, there is no provision for permanent salary continuation for life. Instead, benefits are contingent upon the nature of the injury and the employee's return to work. Option A is incorrect, as medical expenses are covered. Option B is accurate. Rehabilitation services are part of the benefits. Option C reflects that wage loss coverage begins after the first week, aligning with Oregon law. Question 12. In casualty insurance, which of the following principles requires that an insured must have a legitimate interest in the subject matter of the insurance? A. Indemnity. B. Utmost good faith. C. Insurable interest. D. Subrogation. Answer: C. Explanation. The principle of insurable interest requires that the insured have a legitimate financial stake in the subject of the insurance policy. This principle helps prevent moral hazard and ensures that the insured has a reason to avoid loss. ORS Chapter 742 emphasizes this requirement, ensuring that only those with an insurable interest can obtain coverage. Optional indemnity relates to compensation for losses, while option B, utmost good faith, requires transparency in the insurance process. Option D, subrogation, deals with the insurer's right to recover losses, not insurable interest. Question 13. Mr. Thompson runs a small construction business and is seeking insurance coverage for his employees. Which type of policy should he consider primarily to cover workplace injuries? A. General liability insurance. B. Workers' compensation insurance. C. Professional liability insurance. D. Commercial auto insurance. Answer: B. Explanation. Mr. Thompson should consider workers' compensation insurance, which is specifically designed to cover workplace injuries and illnesses suffered by employees. This insurance provides medical benefits, rehabilitation, and compensation for lost wages. Under Oregon law, businesses with employees are required to have this coverage. Optional general liability covers third-party claims, not employee injuries. Option C, professional liability, is for professionals against claims of negligence, not applicable here. Option D is for vehicle-related coverage, irrelevant to workplace injuries. Question 14. Which of the following statements is true regarding the claims process in Oregon casualty insurance? A. All claims must be paid within 30 days of submission. B. Insurers are not required to inform claimants of claim denials. C. Insurers must conduct a thorough investigation before denying a claim. D. Claimants can expect to receive payment without providing documentation. Answer: C. Explanation. Insurers in Oregon must conduct a thorough investigation before denying a claim, as stipulated under the Fair Claims Settlement Practices Regulation. This ensures that claimants are treated fairly and that decisions are based on comprehensive evaluations of the circumstances. Option is misleading. While timely processing is expected, there is no strict 30-day rule for all claims. Option B is incorrect. Insurers must inform claimants of denials and the reasons behind them. Option D is false. Documentation is typically required to support claims. Question 15. In which of the following scenarios would a professional liability insurance policy typically provide coverage? A. An accountant is sued for providing incorrect tax advice. B. A contractor is sued for property damage during construction. C. A delivery driver causes an accident while on a business trip. D. An employee is injured while using faulty equipment. Answer A. Explanation. A professional liability insurance policy, also known as errors and omissions insurance, provides coverage for professionals against claims of negligence, including errors in advice or services rendered. Therefore, if an accountant is sued for giving incorrect tax advice, this policy would typically respond. Option B involves general liability, not professional liability. Option C relates to commercial auto insurance. Option D involves workers' compensation coverage, not professional liability. Question 16. What is the primary purpose of the Oregon Insurance Code as outlined in ORS Chapter 731? A. To regulate insurance premiums for all policies sold in the state. B. To establish the framework for consumer protections in the insurance industry. C. To define the scope of coverage for different types of insurance policies. D. To mandate continuing education requirements for insurance agents. Answer B. Explanation. The Oregon Insurance Code, particularly ORS Chapter 731, serves as the regulatory framework for consumer protections within the insurance industry. It establishes rules that insurers must follow to ensure fairness and transparency, thus safeguarding consumer rights. Option A is misleading. While the code influences premium regulation, it does not set rates. Option C relates to policy specifics but is not the primary purpose of the code. Option D, while important, is a specific requirement rather than the overarching goal of the code. Question 17. Which of the following is considered a common endorsement in casualty insurance? A. Waiver of subrogation. B. Coverage for flood damage. C. Collision coverage. D. Comprehensive coverage. Answer A. Explanation. A waiver of subrogation is a common endorsement in casualty insurance that prevents insurers from pursuing recovery from third parties after paying a claim. This endorsement is often used to maintain good relationships between parties in a contract or agreement. Option B, flood damage, usually requires separate flood insurance rather than an endorsement. Options C and D refer to auto insurance coverage types and are not endorsements. Question 18. How does Oregon law protect consumers during the rate approval process for insurance premiums? A. Insurers can change rates without any notice to consumers. B. Rate increases must be justified and approved by the Oregon DCBS. C. Consumers have no role in the rate approval process. D. Insurers can implement rates based solely on their financial status. Answer B. Explanation. Oregon law requires that any proposed rate increases must be justified and approved by the Oregon Department of Consumer and Business Service (DCBS) before implementation. This regulatory oversight protects consumers from arbitrary or excessive rate hikes. Option is incorrect as insurers must notify consumers of changes. Option C is misleading, and while consumers do not directly approve rates, they can voice concerns during the regulatory process. Option D is false. Insurers must adhere to statutory guidelines and not base rates solely on financial status. Question 19. Which of the following principles of insurance ensures that the insured is restored to their financial position before a loss without allowing for profit? A. Utmost good faith. B. Indemnity. C. Insurable interest. D. Subrogation. Answer B. Explanation. The principle of indemnity ensures that an insured party is compensated for losses but does not profit from the insurance coverage. This principle maintains fairness and prevents moral hazard by ensuring that insured parties do not receive more than the actual loss incurred. ORS Chapter 742 emphasizes this principle in defining policy operations. Option Q, utmost good faith, pertains to transparency and honesty, while Option C, insurable interest, involves having a stake in the insured asset. Option D, subrogation, involves the insurer's right to recover losses after compensating the insured. Question 20. In the event of a claim, what is the first step a policyholder should take according to best practices in claims handling? A. Immediately hire a lawyer to dispute the claim. B. Review the insurance policy for coverage details. C. Wait for the insurer to contact them regarding the claim. D. Document the damages and notify the insurer promptly. Answer D. Explanation. The best practice in claims handling is for the policyholder to document the damages and notify the insurer promptly. Timely reporting of a claim is crucial for an efficient claims process and ensures that the insurer can initiate an investigation quickly. Option A is premature. Hiring a lawyer should be considered only if disputes arise after initial processing. Option B, while important, should occur alongside reporting. Option C is incorrect, as waiting can delay resolution and coverage assessments. Question 21. Which of the following types of liability insurance provides coverage for acts of negligence resulting from professional services? A. General liability insurance. B. Professional liability insurance. C. Employment practices liability insurance. D. Commercial auto liability insurance. Answer. B. Explanation. Professional liability insurance, also known as errors and omissions insurance, provides coverage for negligence claims arising from professional services rendered. This type of insurance is essential for professionals such as doctors, lawyers, and accountants. Option called general liability insurance covers bodily injury and property damage, while option C, employment practices liability, addresses employment-related claims. Option D is specific to vehicle-related incidents and does not cover professional negligence. Question 22. In Oregon, what is the maximum time frame for an insurer to acknowledge receipt of a claim? A. 5 days. B. 10 days. C. 15 days. D. 30 days. Answer. B. Explanation. Under Oregon law, insurers are required to acknowledge receipt of a claim within 10 days. This prompt acknowledgement helps ensure that claims are processed efficiently and that policyholders are informed about the status of their claims. Option is incorrect. 5 days is not the standard requirement. Options C and D exceed the time frame set by state regulations. Question 23. Which of the following endorsements modifies a commercial general liability CGL policy to provide coverage for the liability of subcontractors? A. Additional insured endorsement. B. Contractual liability endorsement. C. Completed operations endorsement. D. Broad form property damage endorsement. Answer. Explanation. An additional insured endorsement modifies a CGL policy to extend coverage to other parties, such as subcontractors, for claims arising from their work. This is particularly important in construction projects where multiple parties are involved. Option B, contractual liability, covers liabilities assumed under a contract but does not extend coverage to subcontractors. Option C, completed operations, covers liability for work completed, while option D addresses specific property damage claims. Question 24. Under Oregon law, how are losses treated in a commercial property insurance policy that includes an agreed value provision? A. Insured receives full replacement cost regardless of the actual value. B. Insured receives the agreed value amount in case of loss, regardless of actual value. C. Insured is paid the lesser of the actual cash value or replacement cost. D. Insured must prove financial loss to receive any payment. Answer. B. Explanation. In a policy with an agreed value provision, the insured receives the agreed value amount specified in the policy in case of a loss, regardless of the actual value of the property at the time of the loss. This provision ensures certainty in coverage amounts. Option is incorrect because the insured does not receive full replacement cost unless specified. Option C describes a standard approach but does not apply to agreed value policies. Option D is misleading. Proving financial loss is not a requirement in agreed value policies. Question 25. What does the term aggregate limit refer to in a commercial liability insurance policy? A. The maximum amount paid for each occurrence. B. The total amount the insurer will pay for all claims during a policy period. C. The minimum amount that must be covered by the policy. D. The total amount of premiums paid by the insured during the policy term. Answer. B. Explanation. The aggregate limit in a commercial liability insurance policy refers to the total amount the insurer will pay for all claims during a specified policy period, usually 1 year. This limit is crucial for businesses to understand their maximum coverage potential within a given time frame. Option A describes the occurrence limit, while option C is incorrect as there is no minimum coverage requirement defined as the aggregate limit. Option D relates to premiums but does not define coverage limits. Question 26. In Oregon, which of the following statements regarding the cancellation of an insurance policy is TIUE? A. An insurer may cancel a policy at any time without notice. B. Policyholders must provide written notice to cancel a policy. C. Insurers are required to provide at least 30 days notice for cancellations. D. Cancellation notices do not need to specify reasons. Answer C. Explanation. In Oregon, insurers are required to provide at least 30 days notice for cancellations of insurance policies, allowing policyholders time to seek alternative coverage. This regulation protects consumers and ensures transparency in policy management. Option is incorrect. Insurers cannot cancel without notice. Option B is misleading. While policyholders can request cancellation, it is not the same as the insurer's obligation to notify. Option D is incorrect, as insurers typically must provide reasons for cancellation. Question 27. Which of the following best describes the term occurrence in the context of liability insurance? A. A specific event that triggers a claim. B. A continuous exposure to risk that results in loss. C. An intentional act that leads to liability. D. A claim filed after the policy has expired. Answer A. Explanation. In liability insurance, an occurrence is defined as a specific event or accident that triggers a claim for liability. This could involve bodily injury, property damage, or any incident that falls under the coverage terms. Option B describes ongoing risks which may not constitute a single occurrence. Option C refers to intentional acts which are generally excluded from liability coverage. Option D is incorrect. Claims must arise during the policy period. Question 20. What is the primary purpose of an umbrella liability insurance policy? A. To provide coverage for specialized risks not included in primary policies. B. To increase coverage limits of existing liability policies. C. To replace a primary liability insurance policy entirely. D. To cover all forms of property damage. Answer B. Explanation. The primary purpose of an umbrella liability insurance policy is to increase the coverage limits of existing liability policies. It provides additional financial protection beyond the limits of the primary policies, ensuring comprehensive coverage for various risks. Option A, while applicable to some extent, is secondary to the primary function of increasing limits. Option C is misleading. Umbrella insurance does not replace primary coverage. Option D incorrectly assumes property damage is covered, which is not the primary focus of umbrella policies. Question 29. Which of the following is a key characteristic of a no-fault auto insurance system? A. Insured drivers are responsible for their own damages regardless of fault. B. Insurance companies can deny claims based on the other party's negligence. C. Claims are paid based on fault determination after an accident. D. Insured parties can sue the at-fault driver for damages. Answer A. Explanation. In a no-fault auto insurance system, insured drivers are generally responsible for their own damages, regardless of who caused the accident. This system aims to streamline the claims process and reduce litigation by limiting the ability to sue for damages unless severe injuries occur. Option B is incorrect. Claims are paid without regard to fault. Option C contradicts the principle of no-fault insurance. Option D is typically not permitted under no-fault systems, which limit lawsuits against at-fault drivers. Question 30. Under Oregon law, what is the minimum coverage requirement for bodily injury liability and auto insurance? A. $15,000 per person, $30,000 per accident. B. $25,000 per person, $50,000 per accident. C. $50,000 per person, $100,000 per accident. D. $100,000 per person, $300,000 per accident. Answer A. Explanation. Oregon law mandates a minimum coverage requirement of $15,000 per person and $30,000 per accident for bodily injury liability and auto insurance. This ensures that drivers carry a basic level of financial responsibility in case of accidents involving injuries. Option B exceeds the minimum requirement. Options C and D are incorrect, as they represent higher coverage limits not required by law.